here we go. Once again, thank you everyone for attending. This is part one of a training that we'll call What You Should Know About Our Mortgage Loan Products. So we'll be taking a deep dive today into a number of our different programs, focusing primarily on some of our more traditional programs, and then following this up with session two with some other programs that we would like for you to be familiar with as you share information with your clients. All right, so our primary objective today is for each and every attendee and anyone else who views this video to gain an understanding of our residential mortgage loan products, to learn the eligibility information and qualification highlights, review program-specific advantages and borrower fit. So as we look to qualify your clients, you'll have a better understanding as to why certain products were selected based on their overall qualifications and what it is that they're hoping to accomplish. And at the end of the day, we want to make sure that each and every one of our mortgage loan originators is able to consult and guide their clients and have a firm understanding when it comes to product selection and the skills and considerations, the considerations that are made when certain products are selected for your customers. Okay. So let's talk first about the various loan product categories. Now, the loans that we offer pretty much fall into 6 different loan product categories, with specialty loans kind of being a catch-all for everything that doesn't fall into one of the categories above. So one of the first categories is your conventional loans. And conventional loans is actually a fairly broad category of loans. It's not, a lot of times people, when they think of conventional loans, they think of primarily loans that are insured by Fannie Mae and or Freddie Mac. Conventional loans by definition are basically loans that are not guaranteed or insured by the US government and are basically funded by private lenders. Primarily loans that are done through Fannie Mae or Freddie Mac. Normally when we refer to conventional loans, we're referring to loans that are offered through Fannie Mae and Freddie Mac. But because it's essentially everything outside of the loans that are insured by the government, it is a fairly broad category by definition. Second group of loans are your government loans, or essentially loans that are insured by government agencies. Now, does everybody know when we say the loan is insured, does everyone know exactly what we mean by that? Anybody want to take a stab at it? Come on now. I know.
Hello, can you hear me? Can you hear me?
Can you hear me?
I can.
Okay.
Yeah, so basically that in the event that the borrower defaults, the government will, I guess, pay it off to the lender or the bank.
Exactly. Exactly. In the event that the borrower defaults, it's basically insurance for the lender, for the bank, against the default of the borrower. so the lender will get paid. Some of the government agencies that are involved in this government lending is for your FHA programs, Federal Housing Administration, for VA, Veterans Administration, and USDA, U.S. Department of Agriculture. And their primary focus are the rural areas. Okay, outside of, the next category of loan products are your non-conforming loans. And these loans are essentially loans that do not meet Fannie Mae or Freddie Mac requirements. And we'll take a deep dive into exactly what those requirements are, but anyone that is unable to, for whatever reason, take out a loan with Fannie Mae or Freddie Mac, or may not desire to take out a loan through Fannie Mae or Freddie Mac due to the requirements, and would want to take out a different type of loan, that particular loan would be considered a non-conforming loan. Outside of that, the next category of loans you have are your jumbo loans, and these are any loan that exceeds the conforming loan limits. We'll talk a little bit about loan limits, how you can identify or find out what the loan limits are by county. And anytime a borrower would like to take out a loan above and beyond those loan limits, more often than not, that particular loan is going to fall into your jumbo loan category. And then you have what's called non-qualified mortgages. You probably hear a lot about them. For those of you who receive emails from the various account reps, a lot of our account reps, they will focus more on their non-qualified mortgage loan programs, or your non-QM programs. These programs are basically for any loan that does not meet the criteria set by the Consumer Financial Protection Bureau, and generally are very flexible when it comes to income and credit requirements. And the reason why these particular loans are viewed as non-qualified is because the Consumer Financial Protection Bureau, essentially, their primary objective is to protect the consumer, obviously, by name, right? So they want to make sure that individuals are not getting in over their head when it comes to their mortgage financing. They want to make sure that lenders, through their programs, are doing their due diligence to make sure that loans are being made based on an individual's, one, their credit worthiness, but also based on their income, their debt ratio, how much they can truly afford. There was a period of time when, back in the day, I've been in business long enough, I can remember back in the day when individuals were making loans primarily, based on how much equity was in the house, because they knew at the end of the day, if the person failed to pay, that they could foreclose on that particular property. So, Consumer Financial Protection, they want to make sure that this isn't happening, especially as it pertains to owner-occupied properties. They don't want individuals getting put out on the streets. They want to make sure that all individuals who sign for loans on their owner-occupied properties meet certain criteria, and also want to make sure that the costs associated with those particular loans are fair and reasonable and do not exceed certain thresholds. And then the final category of loan products, your specialty loans are, this list can go on and on, but these are basically loans that are tailored to meet specific financial needs. Examples of these are your bridge loans, which are temporary loans that individuals can take out to get from one phase of a particular process to another phase. For instance, if an individual has a house that's up for sale, looking to sell a home, needs to pull some cash out for whatever reason, can't wait until the property sells, you can take out a temporary bridge loan in order to get you to obtain the cash to help get you to whenever that closing does occur. Some down payment assistance programs actually fall into the specialty loan program because they are indeed loans. They do help bridge the gap of the down payment that is required, but are still loans. Your HELOC programs, they fall into specialty loan programs, which are essentially, utilizing the equity that's in the property. And obviously by equity, we're talking about the difference between the mortgage balance and the value of the property, using that equity in order to access monies to basically take out lines of credit in order to access monies and to leverage their home in doing so. So those are our 6 categories of loans, and we'll be touching on each and every one of these in detail. All right, so now let's talk about conventional / conforming loans. Again, these particular loans are backed by Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are privately held quasi-governmental organizations that were created by our government to enhance credit flow in key sectors of the U.S. economy, such as housing, agricultural, and education. These companies essentially work in tandem with our government to make sure that that all fair housing guidelines are being, that lenders and also realtors abide by fair housing guidelines, that financing, mortgage financing that is made available to individuals is not being done so in a predatory fashion, and that individuals, the long-term goal is to make sure that individuals are not getting in over their head and acquiring properties and taking out mortgages that are at competitive rates based on their overall qualifications, and also set up so that these individuals can remain in these homes for their duration of the term of the loan without going into any sort of default. Some key highlights of the conventional loans that I do want to point out, and each and every loan application that we look at, we always kind of take a look at the individual's qualifications, and I'll say that our conventional side is always going to be our first look. But then for one reason or another, an individual may not match up as well with conventional as they do FHA, and some of the reasons why we'll go over now. First of all, conventional loan programs, credit score requirement is 620 and above. And when we say credit score, basically what we're doing is we're pulling what's called a tri-merge credit report. We receive scores from the 3 major bureaus, TransUnion, Equifax, and Experian, and we're looking at the middle score of the 3. If that middle score is not above 620, that will automatically disqualify them for conventional financing. In addition, the max debt ratio is 50%. So, and we're talking back end. So can anyone tell me the difference between, when we say back end, what is the difference between your front end ratio and your back end ratio? Anybody know that?
Monthly expenses, right?
Yep.
I'm sorry?
Monthly expenses.
So they both involve monthly expenses. But what's the difference between the two when we say front end ratio and we say back end ratio?
One is based.
Do you want me? Oh, okay, go ahead.
And I'm just, I want to make sure I know this. If I'm not mistaken, the front end is based on, um, scratch that. Go ahead. Someone give you the right answer.
So can everyone hear me?
Yeah.
Hello?
Yeah. Yes.
Oh, okay.
Yeah.
The front end ratio has to do with your income as is expressed with the mortgage payment, and the back end ratio is expressed with everything else.
Correct. Did everybody get that? That was okay. That was Bernard. Do me a favor, guys. When you all respond, just say your name. Oh no, your
Okay.
name pops up on the video. They'll figure it out. Thanks, Bernard. I appreciate it. Yeah, Bernard has an underwriting background, so I know he was gonna get this. So as Bernard stated, the front end ratio is basically your mortgage payment. So that's principal and interest, that's taxes and insurance, that's any association fees, all of those added up, that number in relation to your actual monthly income, okay? And in most cases, when we're looking to get an automated underwriting approval, the automated system would like for that number to be below 47%. Now, your back end ratio is essentially that number plus all of your other monthly expenses that are reflected on your credit bureau. So your total debt, that's basically your total debt, including the mortgage that you have applied for in relation to your income. So conventional, they want to make sure that your total debt, your total monthly debt is no more than 50% of your income. Okay. All right.
And I'm sorry to
So now,
and is that the gross monthly income or is that the net?
always grows. Yeah. So we'll always look at the gross income. So if you're a wage individual, we're gonna look at the amount that you receive before anything, before your taxes are taken out, before any contributions to retirement. We're gonna look at the total gross income that you bring in. And in the case of, let's say, Social Security, we'll even gross that up because, generally there's no taxes taken out of that. We'll gross that up to arrive at a total gross monthly income figure. Good question.
Thank you.
Now, on the conventional side, Fannie Mae and Freddie Mac each have their own 3% down program. The standard conventional loans have a 5% down payment requirement, but each one of them have their own 3%. One is called Home Ready, one is called Home Possible. And these particular loans, the 3% loans, are reserved for individuals who are either first-time home buyers or individuals who their income is under 80% of what we call the AMI, or the area median income amount, for their zip code, county, for the area that they live. Okay. Now I do have some links here. Let me see if, hopefully the link will work when this is in presentation mode. Let's see. All right, so takes you to Fannie Mae has a site. Fannie Mae and Freddie Mac, the information is essentially the same. So if we look for the AMI, let me just put in an address. You stick in you use this particular link, plug in an address. If you wanted to know, let's say if you have, as a realtor, are out showing properties and want to know if your client's income would fall below the 80% so that they could qualify for, let's say, the 3% down, you can go to this particular site. And this particular, I will provide all of these links to you. In fact, what I'll probably do is just make the presentation available to you also. But just put in the address and it will tell you what the median income is for that particular location. Okay. And if you want to know how much your borrower, what their income is, and we'll talk about this during one of our sessions when we actually go through an actual loan workup. If you want to know what their income is, you always can sign into the United Wholesale Mortgage site. Once you log in, you will see all of your loan applications that have come in. We do a good job of making sure that those loans go in under your name. So when you log in, you'll see all your loans for each and every one of your customers. And then there'll be an income tab where you can just kind of pull up and see what your customers' monthly income was calculated to be. So for the 3% down, you have to fall under 80%. All right. I also have a hyperlink here for the 2026 loan limits. I have that information on another slide in this particular presentation, so we're not going to click on that today. Generally, conventional loans, if a borrower does not wish to pay mortgage insurance, they will be required to put down at least 20% of the purchase amount. Or in the case of a refinance, 20% of the appraised value. These particular loans are available in either fixed or adjustable rates. Proposed rental income is allowed. I just had a conversation with someone about proposed rental income before our meeting today. Shana, you remember what proposed rental income is?
Yeah, so if you own a residential property currently, but you plan to rent it out in the future, you can use that as rental income, well, proposed rental income for a conventional loan.
Right, exactly. So the property does not even necessarily have to be rented. As long as the market rate, and it would need to be verified, market rent is consistent. In some cases, they will give the borrower credit for rental income on that particular property. Okay. Now, ultimately, it's the automated underwriting findings that will determine what is or is not required. So depending on what the findings say, the findings may require an actual lease agreement and a deposit on that rental situation at some point prior to closing. But we have had situations where we just use the proposed amount. So conventional will allow for proposed rental income under certain circumstances. And they have what I'll call relaxed property requirements. And that's primarily the reason why conventional loans are preferred by most sellers is because you just don't have to jump through the same hoops in terms of property condition requirements that you do with the let's say the FHA loans. On the FHA, they go through a lot more detail, checking of the house and the overall condition of the house. And many times the appraisal report will cite specific things that need to be done prior to closing, and because those costs end up needing to be paid by the seller, most sellers prefer to go the conventional route because it's less likely that they'll be required to make some of those repairs. Conventional loan programs are ideal for borrowers with strong credit, stable income, and even though 620 is the minimum score, if your borrower is between 620, let's say 620 to 640, it's going to be case by case whether or not they get approved on the automated system. So, yeah, conventional automated underwriting, very picky, very low tolerance for what we call risk factors. So if your borrower is not as strong, we will immediately pivot to, in most cases, a government program like FHA. All right, moving right along. Let's talk a little bit about the conventional loan matrix, just so that you all can be familiar with the different LTVs. And by LTV, that's loan to value, the different LTVs for different loan situations. A borrower on the conventional side looking to purchase a single unit will go up to either 97%. We just talked about the conditions where that would need to be met for the 3% down, or 95%, which is of course 5% down on the purchase side. If they're looking to purchase a 2-unit, they have to put down 15%. If they're looking to purchase a 3 to 4 unit using a conventional loan, they will be required to put down 25%. If they are taking cash out of a property, looking to do a cash out refinance, and by cash out, normally this is any amount over $2,000 is considered a cash out. Single unit, those cap out at 80%. So if they already owe more than 80% of what the house is worth, cash out refinance is not going to be an option for them. 2 to 4 units, they're going to cap at 75%. These are the max that are max LTVs that are available. Ultimately, the automated system will determine exactly what that LTV is going to be. So it's not guaranteed that the system will approve it at that, whatever that max might be. Second homes. Just talking about second homes real quick, a lot of times I'll see on applications that an individual who is a current homeowner wants to buy another house and consider it a second home, and that house is like across the street or around the block or in the same neighborhood. Second home properties need to be at least, in most cases, 100 miles from one another. And the borrower must spend a certain portion of time at that particular property throughout the year. So more often than not, when we see second homes on our loan applications, it's not a second home situation. It's an investment property. But a lot of times our borrowers are savvy enough to know that second homes come with a lesser down payment, so they try to go that route. but just so that we know, so that we can educate. That if it's in the same neighborhood, you know, if it's not a significant different distance from their current home, and it doesn't make sense, and they can't say, well, I'm getting a second home, but I'm going to rent it out. No, you can't do that. I'm going to put it on a long-term lease. No, you have to literally spend a portion of the time each year at that particular house. That has to be the explanation. Otherwise, second home will not work. Purchasing of a second home, as stated, is 10% requires 10% down, and a cash out refinance on a second home single unit, 75% or 25% down. And you can see that on the conventional side, anything other than a single unit will never be considered a second home. Investment properties, single unit, they start at 15% down. However, the majority of them are really 20%. There are lenders that go as high as 85%. Findings will allow for 85%, but the bar would need to be very strong across the board. 2 to 4 units require 25% down. Limited cash out, 1 to 4 units, 25. It goes up to 75%. Single unit, 75%, and then cash out refinance, 2 to 4 units, 30%. Any questions at all about the conventional loan matrix? Just thought this information would be helpful for you all as you have conversations with your borrowers about what it is that they're hoping to accomplish. And, you know, some clients are very adamant about wanting to use conventional financing. Very important that you be familiar with these LTV maximums, so that when you ask certain questions about, you know, how much they owe and what the value is, and that you can kind of advise them as to whether or not that cash out refinance would be a realistic possibility based on where they are in terms of LTV.
Jonathan?
Yes.
Is there a very hard time limit for the amount of time people need to spend in their second home? Or is it flexible? Per year, like the time that would qualify them. Let's say it is 100 miles away and they're spending, like, what is that? Like 2 weeks, 3 weeks, a month?
Good question, Jess. Let's see. The borrower must occupy the second home for some portion, so it kind of leave it kind of totally unclear. It's somewhat of a gray area.
Okay.
But the underwriter will dig into getting a little bit more information as to how the property is to be utilized. Like the second homes that I typically see go through as second homes are like your vacation properties.
Okay.
You know, I got a second home in Ocean City or something like that. Okay, yeah, that makes sense.
Okay.
All right, but I think I just had someone reach out to me about a week ago, and the person wanted a second home, and the house is right next door. So, like, no, that's not gonna work. So, anyway, yeah. So our clients will try this. All right.
Also, Jonathan, just another question, because I know we spoke about this before. Are there any other restrictions for those cash out finances? Because I know you had mentioned like they can't be late on within the like 2 times or something like that. Could you explain that again?
So mortgage late. So most lenders, if not all lenders, will have a hard requirement when it comes to mortgage late in order to take out a loan. Generally, if your borrower has been more than 30 days late, more than once within the last 12 months, that's going to disqualify them for pretty much all of our programs. So that's pretty much set in stone. There are few exceptions to that. Those are like investor, some hard money investment type programs. We might be able to get exceptions, but when we're talking, and even there, those exceptions are rare. But if we're talking owner-occupied, mortgage lates, they're going to draw a hard line in the sand when it comes to mortgage lates. So I don't remember all of the particulars about your situation, Ian, but I know that there were several, like he was late at the time that he had inquired about what we could do for him. He was late on his mortgage. Like no lender wants to take over that loan.
Got it. Thank you.
All right. Any other questions? All right. Conventional high balance loans. And here you will see, and these again are loans that exceed the conforming limits, but below the jumbo threshold. Typically available in high cost areas. They have the same guidelines as your conforming loans, but with slightly higher rates. And for the most part, they require 5% down. So for the areas for the states that we currently operate in, offering traditional loans, as you can see on the high cost side, they can go up to 1.2 million, whereas the limit for the standard conventional loan in the same counties is roughly 832,000. Okay. All right. Talk a little bit about FHA loans. These are loans that these are catch-all loans. So for the individuals who can't qualify for conventional, and we're talking exclusively owner-occupied right now. But individuals who will not qualify for a conventional loan program will immediately pivot to FHA, because FHA is a lot more forgiving when it comes to borrower's profile and overall qualifications. Down payment, a borrower with a credit score as low as 580 and above can qualify for a FHA loan with 3.5% down. And individuals who are between 500 and 579 can also qualify for an FHA loan, but with 10% down. Now, primarily, these individuals will be required to receive an approval for their automated underwriting findings. And we run each and every loan through automated underwriting, unless your borrower has opted for our pre-qual option versus pre-approval. Okay. I didn't intend on touching on pre-quals versus pre-approvals, but why not now? So with the pre-quals, I just want to make you all aware of the fact that what we are essentially doing is we're doing a soft pull, single file, working up their ratios, and giving you an approval as long as the credit is sound. If there are any blemishes on that credit, or if that individual score is marginal, we will not issue a pre-qual. The only way that we can issue something for that particular individual is because is with a full automated underwrite. So I just want to kind of make you aware of that. They have to be crystal clean on the pre-qual side if we're going to issue a pre-qualification. So if you think for any reason automated system might kick that one back, or it's borderline, then pre-approval is always going to be the way to go. So please be comfortable having that conversation with your customers. FHA loans are available for owner-occupied purchases and or refinances only. There is what's called a manual underwriting option. So in other words, when we run your borrower's loan through the automated system, and let's say we get a refer. A refer means basically the system doesn't like the loan. We do have an option of sending that loan, and some of you may or may not have been copied on emails that we've sent to certain lenders that we do manual FHA loans through, where we have them take a look at the credit report, we have them take a look at the automated underwriting findings, and so that they can let us know whether or not that particular borrower meets their criteria. Now, the manual underwriting option, or for the manual underwriting option, the biggest thing is they can have some past credit issues, but they cannot have anything recent. So, you know, normally with installment loans, you know, they want 2 years since the last late payment on any installment debt. Okay, that's your student loans, mortgages, car notes, and they want, in terms of revolving debt, they want the borrower to be clean for at least 12 months, no lates on any revolving debt. One late, they don't qualify. They have to wait until the anniversary of that last late payment in order to go the manual route. Overall, FHA loans are more flexible in terms of credit requirements. Obviously, you know, being able to qualify a borrower for as low as 500 score, with a score as low as 500, is not bad, considering conventional is going to require 620. And even in the case of those 620, like I said, the 620 and 640s, our fingers are crossed, because unless they're strong elsewhere in terms of assets, debt ratio, somewhere, it can't be multiple risk factors, and some of the more common risk factors are, you know, self-employed individual, risk factor, high debt ratio, risk factor, you know, spotty credit, risk factor, length of employment, you know, if the individual is jumping from job to job, risk factor. So all of these things kind of add up, and if the system says there's just too many risk factors, then it's going to kick back and not approve that particular loan application. So overall, FHA, more flexible when it comes to credit requirements, and they will allow debt ratios of up to 57%, whereas conventional is going to cut you off at 50. So, you know, sometimes when we're trying to squeeze a little bit more purchase power for a particular borrower, we may opt to go FHA only because we can get a higher approval, because we can use that 57% to take the amount up a little bit higher. FHA requires what's called an upfront and an annual or monthly mortgage insurance premium. Annual mortgage insurance premium is calculated on a monthly basis and added and worked into the monthly payment. Okay, these are the premiums that pay for the insurance that Ian was speaking about. The insurance that actually protects the lender in the event of default. And these programs are typically ideal for first-time home buyers, especially those who have credit challenges. Any questions at all before we move on? All right, keep it pushing. All right, VA loans. These loans are guaranteed also, but they are guaranteed by the Department of Veteran Affairs. Key highlights: no down payment, up to county loan limit. So if your borrower purchases a home for $250,000, they will have a loan for $250,000 plus the funding fee might get added on top of that, but they will have no down payment. They're still responsible for closing costs, unless some of it's covered by the seller, but no down payment on your VA loans. There is, for these loans, we do have to have an automated underwriting approval in most cases, but there is a manual underwriting option also. So we can send these loans to our lenders that offer manual underwrites to see if we can get those approved that way. Typically, these loans are for owner-occupied purposes only. There is no monthly mortgage insurance. And there is also a funding fee on the VA loans that gets added to the loan amount, depending on their situation, whether they are a first-time user, second-time user, whatever the case may be. In some cases, the funding fee can be waived altogether if they were found to be disabled as a result of the time that they spent in the service. That funding fee can actually be waived. VA loans, for the most part, have their income and credit requirements are just as flexible as FHA, if not more flexible. We have had VA loans that have exceeded the 57% that's allowed on the FHA side in terms of debt ratio. It's very hard to get approved. You really have to be in bad shape to not get approved by VA, for the most part. And it's available for eligible veterans, active duty reservists, and even spouses of these individuals. Any questions? All right.
I have a question.
Yep.
Does VA allow for any like proposed rental income as well, or is it just conventional?
I believe they do, Shanna. That's a good question. I don't recall ever having one. But let's take a look. Yes, VA does allow for proposed rental income.
Okay.
Mm-hmm. Any other questions? All right. USDA loans, probably one of the most underutilized loan programs that are available to borrowers, especially in areas like ours, where there are so many areas that actually qualify. These particular loans were that are guaranteed by the U.S. Department of Agriculture, being offered to allow borrowers to purchase, low to moderate income borrowers to purchase in rural/suburban areas. There, again, just like VA, there are no down payment requirements. They qualify for 100% of the purchase price and are only responsible for their closing costs. Income limits do apply. I did not add that as part of this particular presentation, but you need to be aware of that. There is a low-cost mortgage insurance or annual fee that is involved. Must meet specific location and property guidelines. And I have included here a hyperlink for the USDA site that you can kind of go to, plug in an address, and it'll tell you if that particular address qualifies for USDA financing. Has anyone shown a property that they think might be in an area that would allow for a USDA loan? Well, if not, if you do have a borrower, especially those borrowers that are short on funds and are open to the possibility of looking in some of these areas, this is the site that you would go to, plug in the address, and it'll let you know if that particular property meets the criteria for USDA financing.
I've been getting a lot of questions about USDA. Have we done any of those recently? Do we know what the interest rate on those are looking like?
It's very comparable to what we see on the FHA VA side. As for whether or not we've done one recently, no, probably the last one I've done has been a couple of years. That's what I'm saying. It is underutilized,
Okay.
especially considering the fact that there are a lot of areas out here, areas in southern Maryland, Charles County, Carroll County. There are a lot of counties, Harford County, there are a lot of counties that qualify. I would definitely familiarize yourself with the USDA site. This particular site that you can go to is United States Department of Agriculture. Just put in USDA eligibility search or something along those lines, and you should be able to go here and kind of take a look and see which areas will qualify. You might be surprised. Not all of them are as remote as a lot of people think. So it's a great way to bridge the gap, especially for those individuals who are short on funding, but at the same time, pretty flexible in terms of location.
Jonathan, I still have that client who is looking for the remote location, and USDA was viable for the location, but not for the property guidelines. So it was helpful that you sent me some checklist about some of the things they might look at for the property itself. The property ended up needing to be a tear down, so it didn't qualify, not on the location, but on the actual property, if that makes sense.
Gotcha. Okay. Yeah. Just like with FHA, there are property condition guidelines that would need to be met. So just want to be mindful of that. But for the most part, I would not let that deter you, unless, of course, your situation is like just a situation where it's a complete tear down. All right, let's keep it moving, folks. We are an hour in, so we're gonna come on in, start the landing, prepare for landing, if you will. Just gonna do a quick touch on non-qualified mortgage loans, non-QM. We'll spend a lot more time on these loans. These loans are, a lot of these programs are very popular. A lot of these loans are the ones that can be offered by our commercial loan officers. So it's very important that we be familiar with these particular programs. These are, again, loan programs that are for borrowers who do not meet the traditional underwriting requirements. There are alternative doc programs. In other words, programs that individuals can qualify for, where tax returns are not necessarily required. This is primarily for self-employed individuals. Lenders will accept bank statements. For the most part, they need at least 12 months bank statements, self-employed individuals now, and must be in business for at least 2 years. And what the lenders will do is they'll take a look at the average deposit over the 12-month period. They'll back out anything that looks like it was not from business revenue, like transfers and things of that nature. They will take that average deposit number and apply an expense factor to it. Most individuals will have as high as a 50% expense factor. So if you have individuals whose average deposits are $20,000, they're gonna apply an expense factor to that $20,000, knock it down to 10, and then now 10,000 becomes the dollar amount that that individual will use to qualify, factoring in all of their debt. So it's great for individuals who do not show a lot of income on their taxes. It's very important that these individuals have bank accounts that are solely dedicated to their businesses. If an individual has business income and personal transactions kind of all blended in, it's going to be very hard to get that particular loan done. So I would say they have to have a bank account, or can be more than one bank account actually, but each bank account must be solely dedicated to the business itself. In addition to that, we can do loans for individuals strictly based on P&L statements, as long as the P&L statement is being provided by an accountant. We can do loans based on 1099s. So we'll take a look at their 1099s, the total of their 1099s, and qualify them. And in some cases, some lenders will even use their verification of employment, the verification of employment form. Very few lenders actually do this. Now, these alt doc options, these particular programs cannot be offered by the CLOs. You do have to be a licensed loan originator to offer these programs. Some other alt doc for non-QM program features are there may not be any waiting period, or in some cases, reduced waiting periods for credit events. So if a typical individual who files for bankruptcy has to wait 2 years before taking out an FHA loan, or 4 years to take out a conventional loan, a non-QM loan may only require a year, or if any time at all. Same thing with foreclosures. FHA requires 3 years. Conventional requires 7. Non-QM loan may not require those, or may require significantly less. DSCR loans which we will get into in detail, one of the most popular loan programs available right now, and everybody does them, from your banks on down to your private money sources. Debt service coverage ratio loans where we basically just look at the amount of rental income that is being received on an investment property, or in some cases, the proposed rental income based on comps, based on what the market rent is. And as long as that particular rent covers the payment, principal and interest, taxes and insurance, also association fees, covers those monthly expenses, in most cases, that individual will qualify as long as they have the appropriate credit score. Again, we will talk in detail about DSCR programs in a little bit more detail. Also, fix and flip programs, very popular with, and DSCRs and fix and flips are offered by our commercial loan originators, can be offered by our commercial loan originators. Fix and flip programs where our borrowers can acquire property, renovate the property, and then ultimately refinance the loan. They're normally short-term loans up to about a year on average. And if you have a client that is a investor, they do require some level of experience for the most part. It's a great way to get two loans out of the deal, because you can offer them the fix and flip loan that they get in, renovate, and when the house is all fixed up, they're going to need permanent financing, and we give them a call and follow back up with them and talk to them about converting that fix and flip loan into maybe a DSCR. These programs are designed for self-employed individuals, your investors, and individuals with unique income scenarios. All right, so as a quick summary, conventional, 3% down, 620 score. Mortgage insurance, yes, unless they put down at least 20%. All right, standardized and competitive rates. FHA, 3.5 down. You can go down to 580 at that 3.5 down, or even 500 if they put down as much as 10%. All FHA loans have mortgage insurance, flexible credit, and income requirements. VA, no down payment, 620 score on average. But again, on the VA side, you can go down as low as 500. No mortgage insurance, and is exclusively for our veterans. USDA, no down payment, 640. Very low cost mortgage insurance, 100% financing specifically for your rural areas. Jumbo loans, 10 to 20% down, for the most part, 700 plus scores, no mortgage insurance, high limit home financing. And then your non-QM loans generally require at least 10 to 20% down. Credit score requirements can vary. The higher the loan to value, the higher the score requirements. So on a non-QM bank statement, your borrower's probably going to need at least a 680 to 700 or better for the maximum loan to value. And then normally as the loan to value goes down, the score requirement goes down. No mortgage insurance. Loan programs are pretty flexible in terms of guidelines, and non-traditional income can be used. So again, that is all that I have for you today.